All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. We have two special guests joining us today. This was a last-minute decision to have this conversation with Nick and Kasey Rossolillo of Chipstocks Investor. We were planning to record with them later in February, but everything that's happened with Deepseek and all of the questions so many investors out there have about AI, the implications, what it all means, Jeff and I thought it would be a great opportunity to have our good friends on.
Thank you.
Yeah. Welcome, guys. We're glad to do this because you can help shed some light on this for normal people that don't don't pretend to know what they're talking about regarding high technology.
The last couple of days have been interesting to me because you get reminded, you have these long lulls in the market where there's not any big news. It's just like normal market stuff. And that can be months and months and months. And then all of a sudden, there's always this like big event, this big story. I think the last one I can think of was probably the CrowdStrike outage from last summer.
Yep.
And then there was the yen carry trade thing that happened for like 2 days. But this feels like a pretty big one. Anything related to AI in any way dropped double digits on the 27th. We're recording this on the 28th. It'll be good to sort of take a step back. It's been at least a day. The dust has settled a little bit, but we can dive in to see what happened, if it matters, what signal, what's noise, and all that kind of stuff. So glad you guys are here.
Just to kind of put some numbers around it, the NASDAQ 100 fell by the most since March of 2020. That was a pretty big move. Nick, you used a key word when you were talking about people talking about this. A lot of people pretending they know what they know what's going on, know what it all means. I've been a little bit of one of those pretenders too, because I read Ben Thompson of Stratechery, which means, of course, I know everything about AI, right? Just following Ben.
I think that's all it takes.
Yeah. Yeah.
But Ben had a good write-up on it, though. So you probably know what you're talking about now.
Well, I know what Ben's talking about, and I believe Ben, but I know that with Nick, with you and Kasey, with Chipstocks Investor, you guys have spent, what are you going on your third year, I believe now, with Chipstocks Investor, an analyst and an investment advisor, helping people make decisions about how to invest their money. As an investor yourself, you've spent years here building a thesis around everything going on in the semiconductor industry. And over the past few years, artificial intelligence has been a cornerstone of what's happening. So Jeff and I have said a lot. How about you guys tell us, really just the short version, what is Deepseek? What is the company behind it? What did they do that shook the AI market so much?
Well, I think first we should maybe mention, we got this over the weekend.
We got prepared because we saw what was happening Friday, Saturday. We were worried about what might happen on Monday. And so I went to the store and got a 3-liter box of wine because I felt like I might need it.
For those of you watching on Apple Podcast or Spotify and you're not watching the video feed, yeah, it was a box of wine, a 3-liter box of wine. That is wonderful.
You know what I call a 3-liter box of wine? I call that a good start.
Exactly. Exactly. There was no messing around with the bottles over the weekend. We just went straight to the box.
And Kasey wasn't even going to show up. She was going to bail on me, which would have been lame if it was just us 3 dudes here. 100%. And she said, I don't feel like I'm prepared to talk about this yet. I don't know what Deepseek is. And I said, that means you're actually very well qualified to join in on the conversation, because the secret is nobody really knows what this means yet. Mm-hmm. A lot of people may know what Deepseek is and what it does, but nobody knows what it means yet. And that's the truth. And that's really like the truth with all events like this that causes uncertainty in the market. And that's why the market goes crazy. It's because it's an uncertain situation. We don't know what it means yet.
The market tends to shoot first, ask questions later when it comes to stuff like this. And then it'll usually shake out over time. Like if it's a real thing, those stocks will stay low. And if it's not, they'll start to crawl their way back. And that's kind of how I've been approaching it personally. Just, all right, deep breath, give it a couple days, give it a couple weeks and see where it goes. But anything we can learn along the way, I think will just help us make better decisions.
We had a gentleman named Peter Atwater, who's an academic now, but he wrote a great book called The Confidence Map. We had Peter on to talk about that book. And what we see in these moments is the market's vibes, generally based on confidence, is the direction that we see the stock going. We got the election of Donald Trump in November. The vibes were directionally, corporate profits are going to go up, corporate taxes are going to go down, regulation's going to disappear. It's going to be easier. We're all going to make a ton of money, and stocks have been running from that. And this is maybe the first real like hard shock. And we've had a couple of things along the way where the vibe and the confidence rug got just absolutely snatched out from under tech investors based on the idea, which I'll let you talk a little bit about it, Nick, but with Deepseek's product being almost as good as the latest iteration of OpenAI's product that kind of sort of has the ability to reason and like reach its own conclusions versus finding conclusions that have been run through the training model. Now it's not as good, but the key is that it was built on the ultra cheap.
Yeah, that's right.
Well, we think.
Yeah, that's the claim. That's the claim.
That's part of what I want to dig in on. So,
and honestly, it probably really was done on the cheap. And I think probably circle back to that later on. The claims are true. Like this is open source. They provided all the documentation and invited researchers and engineers to reproduce what they did. So ultimately, this is probably a net positive whenever you have high-end tech getting commoditized so that it can be used more frequently by more people. But maybe to your question first, what is this Deepseek? So about a month ago, it was right around Christmas time, is when V3 came out. And that's kind of when I think we started talking about it over on our Chipstock Investor Semi-Insider Discord channel. It was brought up. What do you know about Deepseek V3? The performance is really good. It costs pennies on the dollar compared to ChatGPT 4.0, which is kind of just your general purpose conversational AI for generating text-based prompts. But then Kasey mentioned it this weekend, and then especially yesterday, you called it Malcolm Gladwell's
tipping point.
Yeah.
R1 comes out on the 20th, and that compares to ChatGPT 01, which is what you said, Jason, the one that thinks. It takes longer to think.
Yeah.
And shows you like documentation of how
01, not 01, 01.
01.
Worst naming conventions, they're just garbage.
It's not great.
No.
It's super confusing. But that one is for more scientific.
Generative AI.
That's right. They asked the AI to come up with the naming convention, and that's why they're so terrible.
They
I
asked
like that.
Deepseek to come up with the new AI thing.
And Deepseek came up with R1. Not much better than 01.
Right.
But it is impressive because this R1, and it compares to ChatGPT 01, is able to reason through complex math problems, science problems, coding software, that sort of thing, and provides documentation. And so these are still even Deepseek R1 is a computing intense workload. However, can be done for a lot less money than ChatGPT 01. And that's what kind of had the market after they stewed on it. Kasey's like, this is like the tipping point, the market, all the AI stocks crash. And it's people digesting, okay, NVIDIA is gobbling up all this money selling these advanced systems. What if they're not needed? Because R1, Deepseek R1, just cut the costs dramatically. What if everybody says, you know what? The H100s I have are going to be adequate for a while.
Yeah. And so it's funny. Like when I first got the news Monday, like I was reading all the articles I could get that were just out on like the normal news sites about it. And they were surface level covering it. And then I read Ben Thompson's write-up, which I had to read like twice because there's a lot of jargon in there that I'm not quite up to speed with, but I got the gist of it. And it did answer a lot of the questions I had. So like the first question I had was, did they really do this with not leading edge chips, or did they find a way to get the leading edge chips, like around sanctions and around export controls and things like that? And it seems like the answer is no, they legitimately did it on these older chips. Now, Ben Thompson did make the point that the dollar amount that we're seeing in the news stories of what it was, $5.6 million, was just the cost of the final training.
That was training this model.
Right.
That's
But there was money put into it prior to that to get it to that point. But it sounds like you guys are either know or are assuming that the total dollar amount for this was still probably a fraction of what the American companies are dumping into AI infrastructure. Is that correct?
Should we go high level first
I think
on this and talk about what the big tech companies are actually spending money on?
Yes, please do.
Okay. Should we plug the truth about the AI
I
bubble?
want to tell our listeners and Nick, Kasey, you guys, I specifically requested when we were knocking out the basic plans for the show, I want you guys to plug content you've made on your YouTube channel, your website, chipstockinvestor.com. We'll have a link in the show notes. Your written content there, quality of the work that you guys have done, and it is valuable for anybody that's looking to learn more about this. You guys have things behind a paywall and some things on free side as well. I will encourage anybody that's interested in this. I don't say this lightly. You guys are a valuable paid resource. Anybody that's interested in this area and looking to make substantial or has substantial investments in it, you want to understand it better, Nick and Kasey, full permission. I want you guys to shill everything that's going to help our listeners understand this better.
Yeah, no shame. Just shill away.
Let the shilling commence.
I used to work in the finance industry, so I mean, naturally it should be me that starts.
You don't. That's the problem, Nick.
Shilling's in your DNA, Nick.
You won't.
Kasey's the noble ex-healthcare worker.
We did do a video on this specific question because the question is, are we in an AI bubble, and will hyperscalers start losing money because they're spending too much in CapEx on AI infrastructure? Is definitely a huge question that we've received a lot. And we did do a video, I think last year.
July.
I think in July, July. And it was the truth about the AI bubble. And we presented a few charts for folks to look at in regards to operating cash flow and to CapEx. And I'll let Nick explain that part. He's better with the financials.
And basically it's this. I think the takeaway everyone needs to remember is big tech kind of shot itself in the foot here by calling this AI investments. And they still talk about it in that light. But let's use just Google as an example, because I think they're the cleanest slate for looking at pure data center spending over a very long period of time. Unbeknownst to, I think, most users of Google search, Google's like the most powerful computing business in the world. They have data centers all over the world full of servers that operate Google search, all the services around that, and now Google Cloud. They have been spending somewhere between, depending on where we're at in any given cycle, every few years, anywhere from 10% to 20% of their revenue on capital expenditures. And that is equipment spent on property, servers that go into the data center. And in the context of where we are right now, yes, we are at the high end. We're something like 17, 18% CapEx to revenue right now, but we're still within the normal historical cycle of CapEx to revenue.
Maybe they're just refocusing their priorities for their CapEx. And to put that into context, trailing 12-month revenue for Alphabet's about $340 billion.
Yeah. They do a lot of revenue. They have lots of computing workloads, and the equipment that runs those computing workloads needs to be refreshed every 4 to 5 years. And so all this spending that's taking place is not all AI. In fact, it's probably a pretty small portion of that spending that's going specifically to things like LLM training, generative AI. Most of the spending, even on NVIDIA equipment, is probably for some of it for very advanced R&D work. Think like Google DeepMind, the AI researcher, but the bulk of it is probably just optimizing Google search and advertising for things like YouTube. I don't think many people want to talk about that story because it's not a very fun story to talk about. It's not very sexy, but that's the truth. And Google actually, if you get commentary from like Ruth Porat before she retired, was calling it technical infrastructure spending, not AI spending. Sundar Pichai kept talking about AI like that was the only thing Google was doing. Ruth Porat gets on the call. This is our technical infrastructure that we're rebuilding. This is just a normal cycle at this point. And so some of this worry that like this Deepseek R1 and V3 is going to blow all of this CapEx out of the water, it's just tens of billions of dollars in wasted spending, is ridiculous because
These are software companies.
yeah,
And
and
largely
that
they-
software has to operate on something, right?
Right.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellow Brick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com.
All right, but let me flip the script on that question a little bit and ask about NVIDIA specifically, right? Because that's the company everyone was talking about yesterday. Because while you are correct, I'm not questioning you that like maybe from a Google perspective or Alphabet's perspective, it's just CapEx spending like I always do. And maybe just a bigger piece of that pie was going to AI related things versus non-AI related things over the last couple of years. NVIDIA's data center revenue would indicate that overall people are buying more of their chips than they used to. So someone must be, if not overspending, then just simply spending on chips because of the AI thing. So where are there companies that maybe are in a little bit more trouble, so to speak, if it turns out like, oh, we could all be doing this significantly more cheaply with older chips and using less power and all that?
So there are some newer entrants to this market. Remember, we're talking about cloud computing, essentially, is what we're talking about. And so a lot of this AI work is just being built on top of the cloud infrastructure that already exists. But there are a couple of companies that got to this party a little bit late and have been spending more than average just to build out cloud infrastructure at all. And so most of the budget is going to the new stuff. So Microsoft actually is one of them. And then the newest entrant of the big four cloud providers would be Oracle. And that one hasn't actually been brought up very much the last few days, but Oracle was kind of the first mover that got this party started. They were the first ones to like launch with DGX Cloud a couple of years ago when NVIDIA rolled that out. And so that's one that is potentially, Jeff, like you said, besides just NVIDIA, maybe finally hitting that cyclical down where everybody kind of hits the brakes a little bit, taps the brakes on spending. Maybe a company like Oracle is one that has been spending a bit more aggressively, and maybe people pull out the magnifying glass on them a little bit and say, hey, what's going to be the ultimate payoff? Not saying that could happen, but it's just a possibility.
So one of the things I've been wondering, and I'd like you guys to tell me if I'm thinking of this the wrong way. One of the thoughts I've had, and I said this to Jason yesterday when we were first talking about this, like it appears to me as a novice who doesn't really understand a lot about this space that part of the reason that Deepseek was able to be developed so much more cheaply on older technology is a byproduct of the fact that they had no choice. It's almost like if you asked me to, I used this analogy the other day, if you asked me to dig a tunnel between my house and my neighbor's house, I could do it with a shovel. It's going to take me a really long time, but I could do it. But if you gave me like professional construction equipment, I could do it a lot quicker. So do you think that like the US companies specifically these big tech companies, just have so much freaking money that they didn't even take the time to consider the fact that they could do it more cheaply. They just threw money at it because they can, because just look at Meta. Like, they've shown us that they can just set money on fire for years and be fine. I mean, they don't talk about the metaverse anymore, but they spent a lot of money on the metaverse for a couple of years there. And here they are chugging along, doing just great. So do you think, is that a fair knock on them, that they're not as judicious with their R&D as they could be because they don't have to be, because they're just so freaking wealthy as corporations? Is that too cynical? Am I too much of a cynic?
No, I've thought about this a lot. And I think to some extent that is probably true, but they also want to be the most competitive. And right now, the most competitive thing up until this point, the most competitive thing was buying hardware from a company like NVIDIA, because it is the gold standard, so to speak, of hardware. And so, yes, they are spending the most money to this company, but it's because they need to stay ahead. That's my take anyway.
It's an arms race, essentially. That's what this was. And I said that about Oracle, like, kind of kicked this whole thing off. Oracle was kind of the newer upstart with Oracle Cloud Infrastructure, with OCI. They suddenly launched this big initiative with NVIDIA, and everybody else is like, we're going to miss the boat on this. We have to keep up at the very least. So part of this is also just an arms race. And yes, they can afford the arms race, Jeff.
Yeah.
And not have to worry about being as judicious as possible, versus Deepseek getting really, really incredibly innovative, and the technical talent in pulling off what they did, going below the CUDA language, the software level of NVIDIA, going below that and tinkering with that base level code to get it to do what they needed it to do. That's where some of the questions are also coming from right now with big tech. Is now people are once again, like we were back in July and August, questioning the practice of just throwing money at the latest and greatest, shiniest data center server toy, that being NVIDIA, and saying, you've got great engineers also on your payroll, make them do something other than just opening up the NVIDIA box and running with it without doing harder work, because DeepSeek just proved that it can be done.
Yeah, I imagine there's going to be some really tough questions in Teams over the next few days and weeks.
Is that next level down from CUDA, is that the same thing, or is that related to one of the things that I learned reading that Ben Thompson article? Was one of the ways DeepSeek is more efficient than the other AI models from US companies is basically that it doesn't run the whole model to answer a question. It like accesses just the part of the model that's relevant to the question. So it's using less compute to answer the query, if I'm understanding that correctly. Is that related to what you just talked about at the software level, or are those separate things? Because I know what CUDA is because I've heard the word, but I don't understand enough about how it works, if that's the same thing or unrelated.
Before you guys answer the question, I think we need to talk, because I do think that this is potentially one of, first of all, they're still using NVIDIA GPUs, which we can go back a decade ago, and GPUs started creeping into the data center and displacing CPUs because you were getting a lot more compute per watt, right? Just there were a more efficient way to do lots of things quickly at lower power demand. And so the CUDA infrastructure, the CUDA architecture, I should say, has been viewed as part of NVIDIA's moats. Could you explain briefly what CUDA is, why it's a moat, and specifically what DeepSeek did that could point towards maybe that moat not being as strong as we might have thought it was?
If we could like maybe invert just a little bit on this, we really don't like the moat analogy in tech. It's more about
that's
like who can move the fastest, who can continuously innovate and deploy the fastest.
Well, this is a perfect example of disruption, right? And why moats in tech are very nebulous.
They probably, if they exist, they're very, very rare. And I think you can make the argument that it's basically big tech. That's why they've gotten so big. They have enough going on. They have enough vertical integration, CUDA basically being part of NVIDIA's vertical integration from hardware design all the way up to the software level that operates the hardware. That's what CUDA is. It's a way to tell the hardware how to operate, how to behave.
It's the tool set software developers use to build and operate NVIDIA GPUs and clusters, right?
Yes. And so, yeah, again, this is maybe one of the questions that is yet to be answered. Deepseek open sourced this and all the documentation is available. So there are going to be lots of engineers trying to replicate what they did. And one of the things that they did was, is it actually possible to do this without CUDA, which of course could open up the door for inference, possibly training. But I think really what we're striking at here is the actual inference once the AI has been trained and deployed and is being used for AMD, maybe even Intel, for engineers to be able to take those hardware systems that lack the easy to use, ready to go out of the box software library sitting on top of the hardware that makes it so easy to use, that gave NVIDIA this advantage in the first place. Could some of these other hardware players get a foot in the door? Did DeepSeek just kind of show the way for everybody to do? Now, the problem with that is you have to have a team of very technically proficient engineers that know how to replicate that. And that's not an easy skill set to go out and find right now.
Okay, so they are separate things. Like I was mixing up two separate. So can you then talk a little bit about this idea that DeepSeek is able to only access part of the model to answer the questions? And because to me, that seems obvious. When I heard that, I was like, oh, that makes perfect sense. Like, why doesn't everyone do that? So what's the reason that OpenAI or any of these other AI models, why don't they do that less intensive way of answering a question that DeepSeek does?
They're all working on it to some level and some extent. There's a lot of reasons why it seems DeepSeek's model is so much more cost efficient to operate. And that's just one of the reasons. When we were talking about this though, this past weekend, what this all reminds me of, because ultimately what this proves is that these AI models that are being trained, the argument has been almost since the get-go that these things are going to be commoditized. What's the business model for these? And what this reminds me of is, what search engines did you use in the 90s, in the late 90s, guys?
Ask Jeeves.
Ask
Yahoo.
Jeeves.
Not Google.
I remember when InfoSeek was the big one. Yeah.
Google was kind of a latecomer.
Yeah.
There was a new search algorithm coming out all the time and people jumping to that different search engine to try it out, try out the algorithm, what was new and unique about it, what yielded better results for this new thing called the internet that everybody was playing around with. And so this is going to continue to happen. It is a commodity. It's just an algorithm. There's no inherent moat with any of this stuff. And so we're just going to continue getting new, this is the part that makes us laugh. Everybody's like, this is a complete game-changing innovation that just came out with R1 and V3 just over a month ago. Is it though? Didn't we kind of expect this to happen? So we made two charts. Can we jump to the charts?
Yeah. OpenAI would do it.
Yeah, that's
Right.
true, Jason.
It's like thinking Yahoo was going to do it for forever in the late 90s.
Yeah.
Right.
When it's just an algorithm. And this is where, actually one of our Discord members actually brought this up before Satya Nadella did, but brought up Jevons paradox.
Paradox, right.
So this is the paradox. Whenever there's any new technology, in this case, we're talking about AI algorithms, the performance increases over time, and over time, the cost decreases. Okay, that's just how technology works. The paradox is that as that price decreases, performance increases, you would think that the revenue derived from this would decrease because the price has fallen so much. But actually the opposite happens. Because the cost has fallen so much, there's more demand for this technology. It proliferates. And so growth over the long term continues. And of course, the cost is range bound at zero. So you eventually kind of reach a point where things plateau, maybe not logarithmically, but you're range bound at zero. So in absolute dollar terms, you start to see a plateau, and that second chart on the cost. And that's where you see things become very broadly adopted, commercially adopted across all sectors of the economy.
The reason
so-
it works with software and technology, the drive software is software. It's often said that it's zero cost. That's not completely true, but it's so infinitely scalable that the fixed costs don't scale up very much at all. with the increased volume, you can have something fall in cost by 95% and get massive growth in revenue and profit from that because of the increased volume, right? So that's the paradox.
So where, just for listeners who are trying to wrap their head around this, because if it's a new concept, like what are some other examples that we've seen in tech history that have followed this paradox? Like what's a real salient example that everyone would be aware of?
Search. Yeah. I mean, if we just continue with the same example, it got kind of expensive in the 90s, right? I mean, we had a little bit of a hiccup there early on with the internet.
But eventually it became so cheap and so easy and ubiquitous and everyone used it, and that's where the revenue came. Right.
For like cell phones. Like,
Yeah.
I mean, I think you could even look at just video games, to be honest. You know, the average new release video game doesn't cost in actual dollars, not adjusted for inflation. It's about the same number of dollars as 25 years ago.
Yeah. They're all $50.
Yeah.
And they've
they
always
were
been
$50 bucks. They were $50 in 2005 too, right?
They were $50 in 1995.
Yeah. But again,
Yeah.
that's the point, is that in actual inflation adjusted dollars, it's gone down exactly as you've described. But because cost or because of usage has increased, plus there's been a benefit on that side, because even the hard costs have gone away for video games because they're all downloads now. You don't even have to go to Best Buy and wait in line and get a disc anymore.
And the result, even if you're a mediocre, middling participant in that industry, you still generate earnings growth by virtue of the fact that your operating costs continue to fall over time.
Yeah.
So your revenue could not move very much, but you're still logging pretty decent earnings growth as a result.
You benefit from the commoditization of all of the inputs.
Hey, everybody, we'll be right back. But first, a word from our sponsors.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. That's right, another investing podcast you need to add to your listening rotation. My name is Brett, one of the hosts, and I produce 2 episodes weekly along with my co-host, Ryan Henderson. On the Chit Chat Stocks podcast, we talk stocks, a lot of stocks, from the hottest names to undiscovered gems, interviewing sector experts, studying super investors and why they are successful, and we have a fun time while doing it. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and never miss an episode.
I think we've gotten pretty deep into like what happened, what this means. I guess my question, maybe we can take a step back and look at this from a little bit of a higher level. So one of the things I noticed about yesterday as we were all watching the market actually do fine, except for AI related stocks. Like I looked at my portfolio and anything that didn't touch AI it was just like a normal day.
And there's a lot of stuff that touched AI, right? I mean, we saw utilities were down.
All the picks and shovels plays also got hit pretty hard. Like, random electronic, like the company that makes wires in data centers, like they got hit. Like anyone who touches data center money, it seemed like got hit.
Yep.
So I guess if you're invested in any of these companies that saw a double-digit, hit on January 27th, as this news broke over the weekend, but that was the first market day. How do you guys think about that? Is this definitely a just wait and see kind of a thing? Do you think it's easy to see that there may be winners or losers here? Like, how are you thinking about it from I'm just an investor listening to this podcast and I own some of these stocks kind of perspective?
Yeah, I think that is a great question because I think I'm at least amongst our members and like all of the news and social media posts, it's obviously a very emotional thing to lose that much, especially if you're invested in the majority of these stocks. But I guess that's where we really preach having a diversified portfolio because it may take a while for this to recover. Like we at this point, I would say we don't know enough to say one way or the other how this is all going to play out. But that leads you back to having a portfolio that's not solely based in the hottest thing at the moment, which right now is the secular growth trend is AI and AI infrastructure.
And it's no coincidence that here in the last couple of months, some of the old arguments resurfaced again about why wouldn't I just concentrate my portfolio in just a very small handful of the fastest growing businesses? Literally, conversation resurfaced again after everything that happened in 2021 and 2022. The question starts coming up. What am I doing with 20, 30, 40 stocks, which is still, can we agree that's pretty concentrated still?
Yeah. If you own 20 stocks and, one stock goes to zero, there's 5% of your wealth gone.
It's gone.
Mhm.
Yeah.
So it's no coincidence that, like Kasey said, here we are fielding questions like that. And then Monday happens, reality.
One thing on that I want to build on, I think is important to remember, is that diversification, just staying on that for a second, is not owning 20 or 50 or 100 stocks. It's having exposure to various different secular tailwinds in different industries and managing your downside exposure to the risks in particular things as well, right? I mean, that gets to the heart, because there's lots of people that probably own 20 or 25 or even 30 stocks that were heavily leveraged to the growth of AI. And again, we just talked about it. Jeff, you mentioned like MCOR, the company it's one of the big electrical contractors that data centers is a huge and growing part of their business. All those nuclear startups that are a bunch of shitco's that people think are going to make them rich because nuclear is going to power all the AI data centers in 10 years or whatever, that these companies aren't even going to be building nuclear reactors. I'm sorry, let me get off of this soapbox. I seem to have stuff. But the point is, like, you can feel diversified because, hey, I own some REITs, I own some industrial manufacturers, I own some fabulous semiconductor designers, I own TSMC, I own the companies that make the hardware. And well, guess what? You do that. It's Always Sunny in Philadelphia gif, and you follow the threads and they all point back to the same risk factors, right? I think it's easy to miss. The diversification really is about aligning risk factors that could undermine a lot of things that you don't expect it, and Buffett, I don't know if it was Buffett or Munger that said diversification is a hedge against ignorance. And I feel like it was a little bit of a slap to the common investor. I don't think it was meant to be pithy advice. I just think it was meant to be like kind of a brag while being a bit of a dick. But risk is what you don't know, right?
I like that you said risk is what you don't know, because what I was thinking was like the question I've had about NVIDIA specifically for the last bunch of months, and I've said this multiple times, is like, I could see both sides of the argument, right? I can see a scenario where this AI spending trend goes on for longer than we think, and either selling or not buying more right now is the wrong financial move. But then I can see the other side where we just get one quarter, we come up on earnings and they are not what people are expecting, and the stock drops 30%, right? Like, either one of those scenarios seems absolutely plausible to me. What's interesting about this news is, like, I don't think anyone had this on their bingo card, right? I don't think anyone had the air coming out of the balloon because there's a better, cheaper, more efficient model that came out of China. Like, I don't know that maybe someone had it on their bingo card. Maybe you guys did back in December when the V3 version came out, but like, I don't think many people were predicting that. But now it's got me thinking, to your point about the paradox, like, if this becomes commoditized and then all of a sudden 5 years from now, 1 million more people are using AI than they are now, maybe all of this shakes out in the wash. Like, maybe this spending is actually going to end up being necessary, just maybe on a longer timeline, because just more people are going to actually use it than if this did not happen. So like, it's like, I thought one thing, then I thought another, and then it sent me right back to the first thing I was thinking. So yeah, it's pretty wild to kind of, I get why you're saying we don't really know yet, because there's just a lot of different ways this could still go.
It gets messy in the short term. Jevons paradox gets messy. We draw straight lines, and it's the Intel move, the Intel profit timeline for Intel Foundry Services chart move, because when you're talking about so many companies reliant on getting people on this train, and you don't know who's going to pull a rabbit out of their hat, like happened here in the last month, you just draw the straight line and say, over the next 5-10 years, this technology will proliferate and it'll come out in the wash. But in the short term, in the days and the weeks and the months and the quarters, even in a year or two, eventually we're going to have a down cycle. Maybe this is the start of that next year, or maybe that first, I should say, actual down cycle for the accelerated computing build out. Maybe this is it. And maybe it lasts a year or two until the next growth cycle resumes. We don't know yet. So it gets messy in the short term, but in the long term, that's where the beauty of being a long-term investor is, and being patient and staying disciplined and following your framework, your investment rules that you've developed, and sticking to it, and not getting lured into doing something dumb because you see other people making too much money in an unsustainable fashion.
Yeah, that's good. I want to, Jeff, go ahead. Then I've got kind of a follow-up.
No, I was just going to say that's where my head is on it, because there's 3 companies in my portfolio that got hammered yesterday. So one is NVIDIA and the other 2 are Broadcom and Arista Networks. And it was like a bunch of green and in my portfolio from yesterday, and then just 3 big dark reds for those 3 companies. But the funny thing is I haven't added any money to them in a really long time, because I bought them a long time ago and I didn't know at the time that we were going to see this AI boom. So I've just sort of watched. I've just been like a spectator, like, oh, look, they're going up and up and up. So the nice thing about that is if you're in that position where you've owned any of these companies for a long time and they've appreciated, a lot, a 20% dip sucks, but it's not like it went, it's not like it's in the red in my portfolio, right? It went from like up 600% to up 530% or something like that. You know what I mean? Like, it's not this huge, but what the long-term investor thing is what helps me get through stuff like this. Because even if that wasn't the case, even if I had bought them more recently, if I do believe that 20 years from now, more people are going to use AI than now, I'm probably smartest by just waiting. I'll just take a step back and watch how this shakes out. Maybe I want to make a bet here and buy a little more when it falls. I don't know, but generally wait and see, because it's that different, like you said, messy in the short term, but maybe over the long term, it all shakes out and, it's all heading in that direction anyway. So that's all I was going to add to that.
You have a good temperament, Jeff.
I try.
It's too good of a line for me to step on top of. I want to talk about stocks, different parts of the value chain of the semiconductor industry and software too, right? Because AI is software. And just to kind of get a sense of what your view is near term and long term. Obviously in the short term, there's uncertainty here. But the way I think about this, we talked about it, based on, Jevons paradox and just the realities, is that to me, this was largely validation about the potential for generative AI. But I think the real story here is that generative AI is nice and good, and companies are hoping to get some revenue out of it and build some AI agents and do some stuff. But really the race is still on, right? To get to artificial general intelligence, AGI. Last general question, and then we'll get into the more breaking out the value chain part. Do you think this represents, what kind of a change do you think this represents in the race to try to get there? Because the bottom line is that what Deepseek did was great, and it's a really good R3, V3, whichever one it is pretty impressive, but OpenAI O1 is still ahead, right? It's still the better product. It is still the one that is closer to being able to iterate to eventual artificial general intelligence. What kind of a change do you think this represents in the approach that the companies that are trying to build AI are going to take?
The race is still on. What we've been doing can be done more efficiently, more cost effectively. However, imagine what a very talented team of engineers challenged to do something more efficiently could accomplish if they had the same firepower as everybody else did. That's the challenge that's been ultimately handed to American US-based tech giants.
Do you think that for the hardware companies, starting with NVIDIA, TSMC is going to be making the chips, whoever's chips they are, but starting with NVIDIA and then looking backwards at AMD and even further back at Intel, which is making some progress and has some things in the works they might actually bring commercial later this year. Do you think this changes the competitive landscape that is going to get more buyers looking downstream versus just focusing on, does this up in Blackwell? Is Blackwell not going to be the barn burner in 2025? that we've seen the hoppers have been prior to that. I mean, how does this, do you think, change the landscape in terms of the companies designing the GPUs?
By the time this publishes, we'll have heard from at least Meta. Who else? We'll have a bit of clarification on that from the people that make the big decisions. Our general thinking is that all this AI is a feature more than it is a product. If we get to AGI, maybe that changes everything. If that happens, I don't know. We'll cross that bridge when we get there. In the meantime, I think we kind of think AI is a feature.
Yeah.
And lower cost is going to do the trick. It's going to get more people to adopt that feature in their software stack, which means you need more hardware to operate that feature of the software.
And as you said, Jason, this version, R1, is not quite as good as what OpenAI has. It's a text-based only. So like you can feed it images and ask it about images, but it doesn't create images or anything like that. So it seems that you can do more with more powerful chips, right? So like if this company, if Deepseek has the same amount of, or the same type of hardware that a company like OpenAI has, they can provide even more computing power. And so the computing power just continues to build on top of each other and create better AI. And eventually, as Nick's mentioned, maybe AGI at that point.
Compute still matters.
Right. Yeah.
It's interesting to me, like as I hear you guys explain all this and I'm thinking through it, it's almost making me more bullish on NVIDIA, if that makes any sense. Like, even though that's the one that kind of took the big hit, because it's the paradox again, right? It's the whole, if more companies can now afford to integrate AI into what they do, because now the overall cost is lower, then maybe they can afford to buy more chips to make it happen. Is that kind of how am I thinking of it the right way? Could this end up being the best news possible for a company like NVIDIA that still has the lead on chips, or am I not thinking of it correctly?
Yeah, because going back to the beginning of our discussion, remember, to date, all this infrastructure has been bought and installed not to operate a silly little chatbot.
Right.
The high-end stuff is doing very, very cutting-edge work that hasn't even come to market yet. Deep research into very, very specific domains of R&D that's still science fiction at this point. Google DeepMind had literally a banner year in 2024, Nobel Prize given out to researchers at Google DeepMind. That's not even been commercialized yet. Chatbots is not the end all be all. Even a chatbot like R1 and O1 that can reason out a mathematical answer for you or a scientific answer for you, or help you code your app. This is like the same thing that hung people up in the 90s. And then I told you so crowd, when it all burst, the imagination wasn't there for where are we actually headed with this? Because hosting a blog was not the end all be all when the overinvestment in the infrastructure finally caught up with us in 99, 2000. If we're headed for that again here, where we stop and say, wow, that was dumb. We spent too much on AI infrastructure. Let's pause and digest that for a while. The imagination is lacking because the researchers are not going to stop with, wow, R1 just kicked our ass and handed it back to us.
Yeah. We don't need to do any more work. They've got it all sorted out over there.
Right.
There's so much, this is the beauty of computing. It's even accelerated computing. It's being used for some very specific things right now that we're now all kind of getting acquainted with, but it's still pretty general purpose. It touches every sector of the economy, but it's still a computer. Even if it's AI, it's still a computer. Someone needs to program it what to do. And that takes manpower. It takes research and development. Then once you figure it out, you have to build up this structure.
And then they'll tell us what to do. But that's another show.
So is a way to think of it to say the spending now is not necessarily for 2025 and 2026's compute, but the spending now is for 2030's compute and 2035's compute and 2040's compute? Like, is that a way to think of it? Like, it doesn't expire kind of a thing? Like, it'll get used eventually? Is there some degree of that in what's happening?
To an extent. I mean, the hardware does wear out. Newer and better systems come out, and you either retire the old equipment after 4 or 5 years, or you relegate it to some basic task. it back in the closet somewhere. So it still has useful life, but it's kind of like the whole corpus of work, right? And this is part of kind of going back again to the beginning of the conversation. One of many reasons Deepseek was able to pull this off at pennies on the dollar was they built upon the AI training that has already taken place before them.
Right. Right.
And so that will continue to happen. The investment gets made and you keep innovating and you keep making breakthroughs. And this is all the long game. These big tech companies are now massively profitable, but not that long ago, like Amazon's become kind of the poster child for this, right? Like operated at a loss for a really, really long stretch of time. Yeah. Now they have like $300 billion in revenue a year, give or take a few 10 billions to work with. That's not going away. Yeah. AWS alone, probably shooting for 120 billion in revenue and growing. These are multi-decade stories. So you do the work, you keep building on top of what you've done in the past and keep pushing the boundary of what's possible.
So one of the areas that I've become increasingly convinced following earnings over the past several quarters and following the thread of what the companies are saying and then what they're actually doing and what their numbers are saying they're doing, is that I've become more and more convinced that when it comes to AI, at least in the near term, in this kind of first push, the companies that are going to see the revenue flow to them are the companies that are already good at a thing, like Salesforce, for example, of companies that are involved in payroll and HR and that are specialists in this thing, the Oracles of the world to some extent. I feel like those are the companies that are probably going to win a lot of the interest in AI because they already have credibility. They know their industries, they know their customers. And if they can integrate AI capabilities, their customers are going to trust them more than they're going to trust a general AI startup that maybe doesn't, that's trying to sell it, AI agents to everybody, right? What are your expectations? Do you think those are some of the companies that are going to probably be the biggest beneficiaries, particularly as we're seeing, like you said, the cost curve potentially changing?
Yeah. I mean, that's our rationale for VGT, right? This year, enterprise software that does a thing. Because again, AI is, at this point anyways, it's a feature. It's not the product. So if you're really good at a thing, this new feature that now just got a lot more cost effective, probably time you start pushing that feature pretty hard.
What you said makes a lot of sense, Jason. An established company that can integrate some form of AI into their workflow already positions itself into being a better beneficiary in the long term and in the short term for now.
And the argument against this was, maybe with all due respect to Andreessen Horowitz, A16Z,
software is eating the world.
Software is eating the world. And, they see constant disruption happening now from this, a new wave of disruption. But, let's just kind of, you guys talk a lot about like trying to figure out what someone's agenda is and what's the word that you use for this? What the
incentives?
The incentives are. They would love to bring up a bunch of brand new AI startups to disrupt the status quo of enterprise AI, like your Salesforces, your Workdays, push that new batch of startups onto retail investors via IPO at a hyped up price, and then start the process all over again.
Right.
Disrupt what they just pawned off on everybody via IPO. So I don't think that that's the eventuality here. That's not how American economics work at this point. It's not that laissez-faire. It's not that libertarian, where competition is pure and perfect, and competition eliminates anybody from ever having like a sustainable long-term lead. So yeah, I think we agree the established winners will probably do very well for quite some time into the future because of these new AI breakthroughs.
I want to encourage people too to remember, sometimes it just turns out it may be a little zero sum-ish, at least for a certain period of time, where they're staving off competition. They're keeping the relationships with their customers and maybe not netting better margins, but they're maintaining the edge and they're staying ahead. I think that's the key. I do want to ask you one question. If you're looking broadly across the technology value chains, are there areas or particular companies that you think maybe the market is maybe underestimating the risk or the opportunity, or maybe the opposite.
Underestimating? Do you have any ideas? You want to start first?
I don't. That's one of the reasons I'm asking you, because it feels like the sector, everything is still feels fully valued, right? Even with this sell-off.
Something interesting's happened because of accelerated computing. Not that long ago, semiconductor industry was kind of one market, one industry. And it didn't matter if it was PC or smartphone or data center or automotive, industrial. It all just kind of moved in lockstep. The market's kind of split at this point. You do have about half of the semiconductor industry. And I'm not talking in like market cap value here, but maybe, a good number of especially older companies that specialize in older, well-developed, tried and true chips, power, sensors, things that go into cars,
right,
and industrial equipment that are still down in the dumps, have not participated in any of this. But if you believe AI will proliferate to all nooks and crannies of the economy, those companies are eventually going to make a comeback. Because if the AI is going to work in some of these applications, let's say like cars, if cars are going to get more intelligent, those chips are very much going to be needed. AI doesn't replace some of these old functions, certainly doesn't replace mechanical functions.
Right. Yeah.
There are actually, I would say this is not as overheated a market as I think many are arguing it is. And that's just maybe one example is like some of the older power and industrial and sensor chips are still down in the dumps. And if you can look out a couple of years into the future and try to pencil in some profit numbers, they look very cheap, perhaps even severely undervalued based on their potential.
Yeah. Last time we were talking, we had you on, we were talking about the risk of China upending the analog semiconductor market. And and here we go. This is at the very bleeding edge of technology. And it seems like that's where they're interrupting it. Not the other end on the commodity side where volume and scale wins. It's the complete opposite end. So who'd have thunk it?
It's almost like markets are irrational thinkers.
It's almost like humans are irrational thinkers.
There you go.
Shoot first, think later.
Predictions are wrong. That's the reality. You guys have any last words before we wrap this up?
I haven't drank all of my wine yet.
Well, now's as good a time as ever to start. So
the market wasn't as bad as I thought, so I didn't need to drink it all.
If you need help,
yeah,
you got to bring them in.
Maybe we need 2 boxes.
That's a good call.
2 boxes.
Yes, thank you guys for coming on. It was great to talk through this news and just get an update on everything. So really great conversation. Thank you.
Thanks for having us.
All right, guys, we look forward to having you back on again. Let's not break the market to have you guys on. Let's just have you guys on.
Sounds good.
Great. Thanks again, Nick and Kasey from Chipstock Investor. Again, look in the show notes. We'll have links where to find their content, their website, their YouTube channel. Please check them out. It's well worth your time and your money. I will say that again. My good friend Jeff Santoro, you ready to short in video with me?
Just end this thing.
Okay. As always, we'd love to give you our answers to these hard questions about investing, the big topics out there that have your attention. But as always, remember, it's up to you to find your answers. You can do it. I believe in you. All right, Jeff. See you next time.
See you next time.